Welcome to Stock Watch with me, Chantal. And joining me to unpack your stock-related questions today are Schalk Louw from PSG Wealth Old Oak and Chantal Marx from FNB Wealth and Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Chantal, Schalk, thank you so much for joining us today. Let's start by looking at the AI threat, right? Just last week, we were focused on the tech rout spurred by software companies. Overnight, some financial counters taking strain as investors assessed the impact of a new AI-powered tax planning tool and the impact it could have on financial services companies. Chantal, I don't know what to make of this. Is this the new normal?
Yeah, so I think that because we have had this massive run-up in anything that has that's related to AI, but we haven't really seen where those impacts are going to be biggest. I think investors are constantly reassessing whether or not they're in the right stocks, whether or not the valuations are justified, and where those disruptions could take place that they previously didn't expect. Personally, I think if a stock is selling off because of the threats of AI, it's way too early, and you can still get really good companies at very reasonable valuations, particularly in software services, and as you mentioned, more recently, financial services.
And piggybacking off some of Chantal's thoughts there, Schalk, is this, the reaction over exaggerated?
Well, let's hope so. I think that'll be the most important thing for global markets. Some of the things that came out this week was just mind-boggling to see the amount of money these companies are spending on AI. This is crazy. We were talking about Google that came out, Alphabet that came out, $185 billion. When we look at the likes of Amazon, $200 expected billion for this year. That's 385 billion dollars just for these two companies. And just to put that in perspective, when you look at the total AI infrastructure spend for 2025, that was in total 375 billion. So these two companies, both of them just going to surpass the amount of spend they're going to do into AI for 2026. And to take that matter further, and this is why I'm saying I hope so, because when you look at that 375 billion in terms of GDP for the US, that makes up 1.2% for the total GDP for the US. And if you look at the expected AI spend, and we know now that this is going to be surpassed. If we look at things like Amazon and Alphabet this week, it seems like the expected spend of close to $900 billion for this year is going to be in the let's call it the shorter side. I think it's going to surpass that. That means that's more than 3% of the US GDP. If it's gonna continue, it's fantastic. I think it's going to be good for the US economy, and ultimately will be good for the world. That said, if it sort of turns around and we don't see those type of infrastructure spend, that improvements, I think it's going to be a tough day for global economy.
Schalk, just sticking with you there around those AI counters, do you think that the AI boom has sort of structurally changed how we view some of these counters? There was an analyst I spoke to recently that said these big tech players are in a transitional phase. We're so used to all of the revenue, all of the income going directly to the bottom line. But here we are a year or two later, where we are seeing a lot of money being spent on the AI bill to build up those data centers, to build up on infrastructure.
Yeah, it's definitely changed the way we think. When we're talking about you're talking about how we do tax. It's just how people use AI. I look at my mother. I mean, my mother is now, if it's not on Grok or ChatGPT or Gemini, one of those things, it does not exist. I mean, this is the new way. I mean, you're talking about, is this the new way forward? It is. So then the question begs, is this a bubble? Now, there was a nice a report that was brought out by the National Bureau of Economic Research, NBER, where they say what constitutes a bubble. Well, firstly, they say that assets should have risen by more than 100% over 2 years. It should outperform the broader market by 100% over that same period, and it needs to deliver, a 5-year return. I mean, it needs to deliver a 5-year return. So it can't come off a very low base. And it is interesting. The question is, do we see these AI companies or more specifically semiconductor type of companies already in a bubble? And the answer is no. When we look at these companies, the semiconductor index is now up closer to 50% over a 2-year period. So we still, I say we're sort of 1 out of 3 for being in a bubble. So I think be careful calling tops. I always hate calling tops or bottoms. I think AI is definitely here, and it's here to stay. It's just a question, very similar, funny enough, very similar to 2000 when they talked about the tech bubble.
Yes.
People were saying, 2000 were saying, you know what, next year or the next few years, you're not going to stand in a queue in a bank anymore. You're going to use the thing called the internet to do your, your banking. You're not going to stand in a queue to book your airplane tickets or those kind of things. You're going to use something like the internet. And, were they correct? Yes, 100%. They were 100% correct in terms of the internet became a total disruptor. The problem is from 2000 to 2000, let's call it 2022, the top 3 companies, again, Microsoft, General Electric, and Cisco Systems. Those companies dropped by 54%, Cisco Systems by 73%, and General Electric, that was also about 51%. So just be careful. Be careful calling tops, but also be careful overextending yourself in this market.
Yeah, crazy. Talking about technological advancements and innovation, we've moved from, the internet just being a use case to social media, to AI, where we have our parents and friends putting in pictures on ChatGPT so you can get a little caricature you can post online. All right, let's move over to another sector that's been really keeping us glued to the screen, and that's the energy market, right? We got 2 companies out with earnings today and yesterday, and I want us to start off with Total Energies. While yes, we've seen oil ticking up over the past day or so, the company reported a slip in profits on the back of lower oil prices. The group also trimming its share buybacks. Chantal, are they pricing in that lower oil price risks on the back of the geopolitical tensions still at play?
Yeah, you would have seen my eyes pop when you said that they're reducing their share buybacks. And that's because BP actually suspended share buybacks completely yesterday. And I think that it's a function of them recognizing that we could be in a structurally lower oil price market, and they need to adjust their cost structure. They need to bring their debt down to more sustainable levels and stop returning so much money to shareholders at the expense of the strength of their balance sheets. They need to prop up their balance sheets to face a potentially lower oil price for longer. And I think that it's the right call. It's probably the more prudent call to make. But I mean, shareholders wouldn't have liked that, right? Shareholders do like cash in their pockets, particularly from companies like the oil majors, where you don't get a really smooth earnings and price appreciation trajectory. You want those cash returns, but probably the right thing to do.
Yeah, that was going to be my next question, Schalk, whether we're seeing a structural shift within these oil counters, with BP, of course, suspending share buybacks while Total Energies trimmed its share buybacks. What I found interesting, though, was the kind of different reaction, market reaction to the numbers and to the decisions around those buybacks, where we did see Total Energies edging slightly higher, but BP taking a knock overnight.
There's a good old saying where they usually say, "Don't fight the Fed." Now, I want to extend that saying by saying that the Fed just got itself a whole new trump card. So, and pun definitely intended. I think these companies are looking at this. Trump has made it very, very clear. He needs two things for the US. He needs lower interest rates, and he's going to put some pressure to get those interest rates lower. And he needs energy prices to stay low, because the last thing that the US now currently want is for inflation to become a problem again.
Yeah.
So I think that this is the dilemma for some of these oil counters currently looking at the environment saying, well, we're going to be buying back shares, but what we're selling is clearly been advocated by the biggest economy in the world, that we're going to need oil prices to stay low, and we can do anything in our power to keep it lower. The question is, do we see these oil counters being cheap? Yes. I think they're currently, when we look at something like BP, they're now trading at forward multiples of around about 6 or 7 times. In a Shell, 7 to 8 times, and Total Energies we just mentioned, which I looked at this morning, it's also now moved into single-digit valuations. So it's really looking cheap. But then it begs the question: could this be a bit of a value trap for people looking to buy into these? It's all on your view on where do we see this going. If we see inflation being behind us, not going to be a problem, then yes, I think that's the case. I do think that inflation might be a little bit an interesting theme for the remainder of 2026. We've got the geopolitical unrest. We've got a few interesting, moving parts currently in the world, and yeah, just maybe watch the space.
Just on that, let me just get your thoughts around interest rate cuts then, Schalk, right? That new appointee, the new Fed Chair appointee, Kevin Warsh, known as a inflation watchdog, right? Do you expect to see interest rate cuts sooner than expected? Also looking at what we've been seeing out of the jobs, the labor market, right? We got the job openings disappointing, initial jobless claims also disappointing. U.S. non-farm payrolls out today, and expectations are for a softer number.
That's it. I mean, the jobs numbers are coming out softer. This is a very, very important one. Because I mean, we haven't even talked about things like for instance, what the gold price is telling us, that there could be a possible stagflation later this year. And for those people who don't know what stagflation is, that's an economy that's not growing, that's job numbers that's not looking good, and inflation that is higher. So if the job numbers are starting to dwindle, then that's going to be a major concern. So when we've seen the job numbers come out, I think I looked at what they call it the CME Fed tool. The CME Fed tool, that's basically a look at the probabilities of rate cuts at the different meetings. Now, when I looked at it, I think a week and a half ago, the probability for the March meeting, I think it's the 18th of March, was around about it's got 85 to 90% levels being unchanged. Now that's dropped off now over the past, let's call it 48 hours, within the 70%ers. And yeah, when we look at the April levels, that is the interesting one. We're now close to 40% probability of a rate cut in April. So I don't need to make a call. Currently, when we look at Mr. Market is telling us we should still see a rate cut being unchanged in March, but there's definitely some pressure for the Fed to cut rates in April.
All right, let's get into the luxury market, Chantal. Kicking things off with Ferrari, out with numbers today. And it seems like, it's set to end a rough recent run when it comes to the lower share price, right? With its shares trending higher following market-beating results and solid guidance for the year. What did you make of the numbers?
Yeah, I thought the numbers were great, and I'm really happy that Ferrari was able to deliver in this quarter and provide us slightly better guidance relative to that capital markets day in October last year. That just it blew my mind that they were being so conservative. And perhaps to that point, I think one of the things when we're looking at international stocks that we need to realize is that US company management teams and European company management teams are completely different. The Europeans tend to be so conservative in their guidance, and that Capital Markets Day, I think, really and the outcome that we've seen now with this result shows us that these guys would rather be safe than sorry, and they'd rather under promise and over deliver. But all in, I thought it was really positive. The order book still 2 years covered. I mean, they forward sold cars for the next 2 years. So you've got that certainty of cash flows coming through. They've also received a really nice boost from new sponsorships for the F1 team, complementing revenue, margin positive. Overall, a company I really like, and lots of runway for share price appreciation from still very depressed levels, I think.
I mean, what does David say? He says that you wait over a year. You'll order the car, but you'll wait for over a year before it's delivered to you. I find that very, very fascinating. Just getting your views on some of the other luxury counters that have come out with results. We saw Kering and LVMH not doing that well, but, you know, you have your Richemont and Burberry also pushing ahead. Your assessment on the sector as a whole, it does seem like not, you know, all luxury companies aren't equal.
Yeah, that's the one. That's the one. It's not all created equal. Remember, you know, when we look at the likes of the Richemonts, they've got the Cartier watches, and it's sort of the harder type of, it's got luxury commodities that they're selling. You know, your gold and little diamonds and those kind of things, and the softer commodities, the leather type of products, is definitely not doing as well. But I think, I mean, you know, Kering's results were good yesterday. It really surprised on the upside, and I think the share price reacted. I think it was 10% up after results came out. So clearly, when it's like Chantal said, there's a different buying pattern, you know, globally. I tend to think when you look at the luxury goods environment, it's always been sort of resilient. And why would I say that? It was interesting to note within the COVID environment is where, the moment things, you know, were getting tough, I mean, we saw a massive pullback in most companies, but the sharpest recovery came from luxury goods. Because what happened, when the moment people took off their masks and they could do some shopping again, even online shopping, what did they buy? They bought a hell of a lot of luxury goods. They put their names on for new Ferraris, they you know, bought their Cartier watches and their Gucci handbags. So yeah, I'd say it's still a fairly defensive sector. And I must say the results, you know, coming from Ferrari, coming from Kering, it looked very, very good.
What about your take on Richemont, right? We saw good numbers coming through, but there has been concern around the higher gold price and the kind of margin pressure that impact that will have on Richemont's margin pressure. And I mean, no one knows where gold is going at this point, Chantal.
Yeah, I mean, it depends on their ability to increase prices, which I think they actually have. They've got quite strong pricing power. So there could be a margin hit, but I wouldn't anticipate it to be as big as the bears expect it to be.
Okay.
The reality is that they are selling something that people really, really want. And people that buy jewelry in that price bracket and buy watches in that price bracket aren't that sensitive. No. And additionally, the margins are very, very high. And I think they can play around a little bit on the OPEX line as well to counter any sort of real massive gross margin pressure.
And let's get your thoughts around, okay, sticking in the, you know, the market around gold, Chantal. Pan-African Resources out with an update, of course, benefiting from the higher yellow metal price.
Yeah, Pan-African Resources has been my favorite for a very long time. I love the way that they do business. They're very, very conservative and experienced operators. And you won't see their cost slip when the gold price is high. And I think that has translated into a very positive outcome. They're also no longer hedged. So last year and the year before, they actually were hedged at lower gold prices. Yes, so that impacted them a little bit. And then they brought on a lot of new production. And it's not for the whole full 6-month period. So you're probably going to continue to see that supporting them if the gold price remains quite high. Tenant in Australia and the MTR project locally. So I'm excited for them because they've got an increasing production profile,
yes,
and now the support from high gold prices. And as I mentioned earlier, they're keeping their mining costs quite low relative to that basket price or that gold price.
Schalk, higher volumes, higher gold price, of course, that working in Pan-African's benefit. Is that a pick you like within the gold sector, mining sector, that is?
I love gold. I just love gold. I mean, it's like asking me which one of my kids do I love the most. And you're making me think now. Sorry, kids. No, it's just phenomenal. I mean, looking at close to 200% increase in EPS. This is what we expected. I mean, when you look at the average gold price received over this called a trading state of the six-month period, they had an average gold price which they received of just over 3,800 per ounce. And we know where the gold price is currently standing, and we know, as Chantal mentioned, that they've got most of their gold now unhedged, meaning that nothing is sort of sold in advance. So we know that average of 3,800 odd dollars per ounce is now going to increase even further. Now just to put this into perspective, we didn't see in the trading statements they're all in sustainable cost. But if you look at the previous update, I think that was something, and it was earlier this year, earlier January, they came out and said that they all in sustainable cost should be around about $1,825 to $1,875 for this year.
And where's the gold price? My gosh. Exactly.
I mean, we're talking about a profit margin, over this period of over 50%. Now, why is that significant? We're talking about AI companies that's done phenomenal. The semiconductors. We had ASML that came out with a trading update trading update 2 weeks ago, and they mentioned that their profit margins are now trading anything between 51% and 54%, and then the market just went bonkers. I mean, 50-odd% profit margins. Well, that's Pan-African Resources up to December. I mean, we're currently sitting with a gold price of over 5,000, around about the $5,000 mark. That's pushing their profit margins up even further, over 70% now. So that's not all. I think that the one thing that stood out for me, and this is where I agree with Chantal, that this is a great managed company. When you see these type of movements in the underlying commodity prices, you want to see this in a PGM mine, you want to see this in a copper mine. When you see an environment where the gold price did what it did, they also managed to increase their production by over 50% over the same period. I see people literally going in with picks and shovels for 26 hours a day. That's what I'm seeing in my head if people you're sitting in an environment where the gold price is trading. So phenomenal trading update, but I still think if the gold price stay at these current levels, the best is yet to come.
So very passionate about gold, but that's not your stock pick. We've got about 2 minutes, 1 minute for each of you. Schalk, where are you seeing value at the moment?
Yeah, I'm gonna stick to the luxury goods environment. After I've seen Kering's movement, or let's call it update, and the share reaction, I do think that the likes of the LVMH is looking attractive for me at current levels. Locally I do own and do love my Richemont, but LVMH I think is looking attractive, both on a forward PE basis. When you look at historically, it's now trading at the lower side, and also price to books. So valuations is attractive, but clearly the market is telling us they still love anything shiny. They love the expensive stuff.
All right, and do you like the expensive stuff, Chantal? Where are you seeing value at the moment?
Yeah, I'm liking the very cheap stuff at the moment, and that is just a cheap stock, right? So Naspers, and you can take Process as well, it really doesn't matter at this point. These companies have sold off heavily towards the end of last year up until now. Tencent has come under pressure, I think unfairly so, regulatory fears flaring up again. I see this as a trading opportunity. Naspers and Prosus, on top of the Tencent move, has also seen their discounts widen, despite some really positive progress from a portfolio management perspective at a group and company level. So I think the stocks just look cheap. Maybe they can get even cheaper, but I would be happy to start taking some exposure right now.
All right, let's leave it there. Thank you so much for your time and sharing your insights with us today. That's all for Stockwatch. Thanks to my guests, Chantal Marx from FNB Wealth and Investments and Schalk Louw from PSG Wealth Old Oak. Up next, it's The Close.